Welcome to the debate. Imagine for a second that you're trying to build a house, right? You trust your tape measure completely. You pull it tight across a piece of lumber, you read the numbers, and you make your cut. You just assume an inch is an inch.
Right, of course you do.
Yeah, but imagine trying to frame that house if your tape measure was made of elastic. Like the harder you pull it, the longer the inches get.
Oh, that would be a nightmare.
Exactly. Suddenly, your measurements aren't telling you about the wood at all. They are just telling you about the tension on the tape itself. And today we are looking at the global economy, and I think our financial tape measure, the fiat dollar, is just stretching under unprecedented tension. We're analyzing two absolutely staggering macroeconomic signals from late 2025 and early 2026.
Yeah, the first one being the Buffett indicator.
Right, the ratio of the U.S. stock market capitalization to GDP, it just hit a record 230%. And then over in Japan, the central bank just burns roughly $35 billion in a single trading session on April 30th just to defend the yen.
Yeah, it's massive. And the central question we have to answer today is really how to interpret these massive extremes, right? Are we looking at a market that is just fundamentally overvalued and pointing toward an inevitable, violent mean reversion, like a historic crash back to the trend line? Or, and I know this is what you are going to argue, do these signals indicate that our standard unit of measurement has fundamentally broken under the weight of demographic stagnation and massive debt?
I mean, yeah, exactly. I look at that 230% Buffett indicator, and I don't see a market that is just about to crash. I see a broken ruler.
A broken ruler.
Yes, we are entering this era of structural debasement where traditional mean reversion analysis is just, well, it's functionally dead. Those metrics are just reflecting the erosion of the fiat unit. It's the elastic tape measure.
See, and I strongly disagree with throwing the ruler out entirely. I think dismissing historical mean reversion is a deeply premature and, honestly, an incredibly dangerous miscalculation.
Dangerous? How so?
Well, yes, the fiat unit is under stress. I won't deny that. But the assumption that demographic headwinds are this inescapable doom loop, one that absolutely cannot be overcome by new productive mechanisms like AI, it just ignores the proven historical resilience of capital markets. I mean, the laws of financial gravity haven't been suspended just because the numbers are scary.
Well, let's start right there with the numbers, okay? Specifically, the Buffett indicator sitting at 230%. If you are a standard financial analyst, you look at that chart, you see it sitting 75% above its historical trend line, and you expect what? A 25 to 43% drawdown?
Right, standard mean reversion.
Right. You assume it has to mean revert. But that ratio is fundamentally flawed today because it assumes liquidity distributes evenly through the economy. And it just doesn't.
You're talking about the difference between the numerator and the denominator here.
Precisely. So the numerator is the market capitalization of equities, and the denominator is the gross domestic product. Both are denominated in dollars. But when central bank liquidity is deployed into the system, how does it actually move?
It goes into the financial plumbing.
Exactly. It doesn't go into the pockets of everyday workers to buy groceries right away. The Fed buys bonds. They inject reserves into institutional accounts. Those institutions don't go out and buy consumer goods, right? They buy financial assets.
Sure. They buy equities, real estate.
Yes, so the liquidity hits the numerator, the equities, long before it ever trickles down into wages or organic GDP growth in the denominator. Asset price inflation compounds substantially faster than consumer price inflation.
Okay, I hear that, and I readily acknowledge there are structural asymmetries at play here. For example, there's actually another massive flaw in the Buffett indicator that we should mention. Roughly 40% of S&P 500 earnings now come from outside the United States.
Right, global revenue.
Exactly. Whereas GDP is strictly a measure of domestic economic activity. So you're comparing a global revenue stream against a domestic output metric. It's totally an apples to oranges comparison.
I agree with that.
But here is where I have to push back. Declaring that the unit of account is permanently broken just to justify a metric sitting 75% above its historical average? I mean, come on. That is exactly the kind of new paradigm rationalization we hear at the peak of literally every major historical bubble.
Wait, so you think it's just a standard bubble?
You think this is just 1999 all over again?
I think the asymmetry between asset price inflation and consumer price inflation you are pointing to might just be temporarily stretched. Like your analogy, it's an elastic band, yes? But bands snap back.
Or they break.
Sometimes, but the broken ruler theory relies heavily on this deeply deterministic view that the system is structurally trapped. It assumes the central bank will never be able to normalize things, and that sets up a really dangerous mindset for investors.
But they can't normalize things. That's the whole point.
Well, if real productivity eventually catches up to the liquidity that has been injected, we are going to see organic economic growth that can easily support a traditional market correction. Telling people that mean reversion is dead exposes them to catastrophic downside risk when that band finally snaps.
I see why you think that. But let's look under the hood at the mechanical constraints of the system, because this isn't just about investor psychology. It's about mathematical reality.
Okay, let's do the math.
Whenever anyone makes the argument that the central bank will eventually get things back to normal, the historical anchor they always point to is Paul Volcker in 1981.
Well, yeah, he's the gold standard of inflation fighting. I mean, he raised the Fed funds rate to 18%, broke the back of inflation, and the economy took the punch and kept going.
Right, but why did the economy survive that punch? It worked because 4 very specific conditions existed simultaneously in the 1980s that simply do not exist today. First, the working age population was growing by about 14 million people per decade.
Demographics were strong, yes.
Exactly. Second, working age employment was growing in lockstep with that population. Third, energy consumption, which is a fantastic proxy for raw industrial output, was rising sharply. And fourth, and this is the crucial one, the federal debt to GDP ratio was sitting at just 31%.
So you have high demographic growth, expanding industry, and very little systemic debt.
Precisely. Now, fast forward to 2026. The demographic boom, it's gone. Employment growth among a working age population is functionally flat. And that debt to GDP ratio, it's not 31%, it's 123%.
It's high, obviously.
Let me put that in perspective for the listener. At a mere 4% Fed funds rate, the annual interest expense on the national debt already exceeds the entire budget of the Pentagon.
Yeah, it's wild.
It's over $1 trillion just in interest. If a modern Fed chair tried a Volcker-style move, not even 18%, just taking rates to 10%, it wouldn't restore price stability. It would instantly trigger a sovereign debt service crisis.
Because the Treasury simply couldn't afford the interest payments without issuing massive amounts of new debt to pay the old debt.
The Volcker tool isn't just impaired right now, it is mechanically unavailable. The underlying productive base of the economy cannot absorb a rate shock of that magnitude, and if the central bank cannot use the interest rate tool to force the mean reversion, then a historical mean reversion cannot mechanically happen.
See, that is a compelling argument if and only if you assume the only way to grow an economy is by adding human beings.
It's the primary way we always have.
Sure, historically, but you're treating the demographic doom loop as an absolute certainty. You're basically saying working age headcount is flat, therefore economic output must stagnate. But hold on, I have to stop you there, because you are completely ignoring the wild card that fundamentally alters how we measure productivity.
Let me guess. Artificial intelligence.
Yes, artificial intelligence.
I'm not ignoring it. I'm just waiting for it to actually show up in the macro data.
But structural shifts take time to manifest in lagging indicators like GDP. Think about the mechanism of AI here. Can artificial intelligence and autonomous systems materially shift output per worker and permanently solve the demographic problem? I argue the answer is increasingly yes.
A permanent solution?
Yes. AI isn't just a slight efficiency boost. It's like upgrading the engine while the car is still driving down the highway. If the workers we have are suddenly doing the output of 5 or 10 people, you've effectively decoupled economic growth from raw working age headcount.
Okay, but
You don't need the 14 million new workers per decade we saw in the 1980s to restore the productive base. We can compute our way out of the demographic shortfall.
what about the industrial base? You can write code faster, sure, but you still need energy to run an economy. You need physical things.
That's exactly my point, actually. You mentioned energy consumption earlier, implying that because it isn't rising like it did in the 80s, we are in industrial decay. But I look at declining energy consumption per capita and I see massive efficiency gains.
You see less energy use as a positive?
Absolutely. We are producing significantly more economic value per unit of energy today than at any point in human history. If AI capital substitutes for human labor, the productive base expands organically, tax revenues rise, and the capacity of the state to absorb higher interest rates returns. The math fixes itself through innovation.
I mean, I love the optimism, really. But let me push back on the premise by looking at the mechanical, unyielding relationship between the money supply and actual productivity over the last 30 years. AI is a plausible upside. Sure, it's a great narrative.
It's more than a narrative.
But let's look at the actual arithmetic of the system we are currently operating in. Since the 1990s, the demographic and debt patterns have totally inverted. Tax revenue tightly tracks working-age employment, which, as we established, is totally flat. But on the other side of the ledger, social spending tracks the 55-plus population, which is just booming as the baby boomers retire.
And you're asking how that gap gets closed.
Right. It gets closed through massive, continuous debt expansion. We are projected to add roughly $14 trillion in marketable federal debt in the 2020s alone.
True, but debt expansion doesn't inherently mean the end of the system. If the debt is funding future productive capacity like infrastructure or technological transition, it pays for itself over time.
But it isn't funding productive capacity. That's the issue. It's funding existing social commitments and the interest expenses on past debt. And this leads to what I think is the most damning piece of evidence for the broken ruler theory: the asymmetry in the money supply.
Okay.
If you pull up a chart comparing Fed net liquidity against U.S. government debt as a percentage of GDP since the 2008 financial crisis, the two lines track each other almost perfectly.
Well, yeah, because the central bank stepped in during crises.
They didn't just step in, they became the market. Every single acceleration in federal debt over the last 15 years has been met by a corresponding acceleration in liquidity provision from the Fed. This isn't just a temporary coincidence. It is the structural policy.
I wouldn't call it structural policy.
It has to be. When the productive base cannot absorb rate shocks because of the massive demographic and debt burdens, the central bank has to act as the buyer of last resort to keep the bond market functioning. That money supply expansion is actively masking the lack of real organic productivity. And where does all that liquidity go?
You're going to say assets?
Straight to the asset column. That is precisely why the Buffett indicator is at 230%.
Look, I'm sorry, but I just don't buy that framing. Let me tell you why. I acknowledge the tight correlation between Fed liquidity and debt expansion since 2008. The charts don't lie. But your conclusion that this represents an endless systemic debasement that purely masks a lack of productivity is a fundamental misinterpretation of central bank mechanics.
How so?
What if that liquidity isn't masking a collapse? What if it is acting precisely as it should, as a shock absorber during a massive demographic and technological transition?
A $14 trillion shock absorber. That's a pretty expensive suspension system.
Yes, because the scale of the global economy demands it. Look at the April 30th event we brought up at the start. Japan deploys $35 billion in a single day to defend the yen. They coordinated that with U.S. officials under the G7 framework.
Right.
You view that intervention as a desperate symptom of a collapsing system. I view it as coordinated, targeted stabilization. Central banks are managing cross-asset volatility. Just because they step in to smooth out the transition doesn't necessitate endless hyper-debasement.
Oh, come on. Defending a currency by dumping $35 billion into the open market is the definition of putting a Band-Aid on a structural hemorrhage.
No, think about the logic there. If the central banks were truly resigned to hyper-debasement, if they agreed with your broken ruler thesis that they just have to inflate the debt away, they wouldn't burn $35 billion of foreign exchange reserves trying to defend the currency.
Yes, they would.
No, they would just let the yen slide. Letting it inflate away would actually solve their internal debt problem faster. The very fact that they intervened proves they still care deeply about the integrity of the fiat unit. They are trying to preserve the ruler, not break it.
I'm just not convinced by that line of reasoning, because intervening in the FX market to prevent a disorderly currency collapse is exactly what you do when your actual underlying playbook is financial repression. You don't want a sudden crash. You want a slow, managed burn.
A managed burn.
Yes. Let's force the issue here by looking at the actual options on the table. When sovereign debt gets this high, history shows us there are really only 3 inescapable pathways to resolve it.
All right, lay them out. Let's hear them.
Okay? Pathway 1 is financial repression. For those tracking the math, financial repression essentially means the government forces interest rates to stay artificially lower than the real rate of inflation. You are quietly melting away the value of the debt in real terms without ever technically defaulting on paper. I assign a 60 to 70% probability that this is our current reality.
Okay, so that's the base case. What's pathway 2?
Pathway 2 is fiscal dominance, roughly a 20 to 30% probability. This is where the Treasury explicitly dictates terms to the central bank, forcing them to print money to fund government operations because rate hikes would trigger a sovereign debt crisis.
Right.
And pathway 3 is a coordinated restructuring, something like a new Bretton Woods agreement, which is maybe a 5 to 10% tail risk.
And your argument is that Japan's intervention proves we are firmly in pathway 1, financial repression.
Exactly. The yen intervention proves financial repression is the active playbook. Deploying $35 billion to prop up a currency shows that central banks have moved far beyond traditional monetary policy like, tweaking the overnight rate, and have become active, heavy-handed managers of cross-asset volatility.
I still don't see how that proves inevitable debasement.
The line between monetary policy and outright price control has been erased. They are purposely bending the ruler. They need to ensure the debt burns away in real terms via inflation while propping up the nominal facade so the bond market doesn't panic.
I challenge your probability weightings fundamentally here. You are assigning a 60 to 70% probability to financial repression as if it can just be sustained indefinitely without breaking the system. But the source material for this framework explicitly outlines falsifiable conditions.
Falsifiable conditions?
Meaning there are triggers that prove your theory wrong. If the debt-to-GDP ratio falls below 80% without a default, or if the Fed funds rate can be sustained above 6% for 24 months without triggering a major bailout, your entire architecture of inevitable debasement breaks.
But we haven't seen either of those things happen, and we aren't going to.
We haven't seen them yet, but again, I have to ask you, if financial repression and debasement are so completely inevitable, why bother with massive FX interventions? Defense of the currency is fundamentally counterproductive if your primary goal is to inflate away your debt.
Like I said,
By selling dollar reserves to buy yen, Japan is actually tightening global dollar liquidity. That defense suggests policymakers are fiercely committed to maintaining the purchasing power of the currency. They want the tape measure to stay accurate.
they are defending the pace of the decline, not reversing it. A disorderly overnight collapse of the yen threatens global collateral chains. If it crashes too fast, margin calls ripple through the global banking system. An orderly, managed debasement is the goal.
I guess we just read their motives differently.
Which brings us to the most critical part of this analysis, really. What does this macroeconomic architecture actually mean for the listeners today? If you are a long-term investor looking at your portfolio, how do you measure your wealth?
Well, if you believe in traditional mean reversion, the playbook is pretty clear. You see the Buffett indicator at 230%, you recognize it's wildly overvalued, and you hold cash. You wait for the 30 or 40% crash, you buy the bottom, and you capture a massive real return.
Exactly. That is a traditional playbook. But that strategy only works if the unit of measurement, the dollar, is stable. In my base case of structural debasement, cash is not a safe haven at all. Cash is a melting ice cube in a closed room.
A melting ice cube.
Yes, it erodes materially and purchasing power over time. Meanwhile, scarce supply assets massively outperform because they actively reprice to absorb all that newly printed liquidity.
So you're arguing people need to abandon the dollar as their benchmark entirely.
Yes, we absolutely have to disentangle measurement from holding. If we stop measuring our portfolios in fiat dollars, which are actively being debased, and start valuing assets in fixed supply digital units, the picture changes entirely.
It certainly looks different on a chart.
Right? If you price the S&P 500 or real estate in a non-debasable, fixed supply metric, you realize those assets haven't actually inflated nearly as much as the nominal dollar charts suggest. The 230% Buffett indicator is elevated, yes, but it is mostly capturing the rapid devaluation of the dollar,
not just an irrational equity bubble.
Okay, conceptually, I completely accept the intellectual value of pricing assets in fixed supply units. It is a fascinating exercise to look past fiat debasement and try to see the real performance of an asset.
It's essential.
But I have to issue a very, very strong warning on the practical limitations of that framework. It is vastly different to use a fixed supply unit as a theoretical yardstick than it is to actually risk your capital in those instruments to avoid short-term volatility.
How so?
Because on a 3-month or 6-month horizon, fixed supply digital instruments do not behave as stable stores of value. They behave purely as high beta risk assets tied directly to global liquidity. If you are holding them to protect against a crash, you're in for a massive shock.
They are highly volatile in fiat terms, yes. I don't dispute that at all.
But that volatility matters immensely in the real world. You can't pay your mortgage with a conceptual yardstick. If a global liquidity crunch hits, if the central banks miscalculate and the system seizes up, those fixed supply digital assets are going to drop right alongside standard equities and often much harder.
In the short term, maybe.
Anyone using them for short-term protection against a market drawdown will be severely disappointed. Using them to measure your wealth over a decade is intellectually stimulating, sure, but using them to protect your wealth in a 12-month window is incredibly risky. This is why traditional mean reversion analysis and holding tactical cash still plays a vital, necessary role in portfolio construction. You cannot just ignore the short-term business cycle just because you have a 10-year thesis on fiat debasement.
I hear your warning on short-term volatility, and honestly, it's fair. But pulling it all together, my stance remains that the prevailing architecture of the global economy is one of debasement and financial repression. The demographics have structurally shifted, the debt burden is mathematically insurmountable at positive real interest rates, and the central banks really have no choice but to absorb the difference through constant liquidity provision.
Even with AI?
Even with AI. For long-term investors, this means we must treat traditional valuation metrics like that terrifying 230% Buffett indicator not as an impending warning of a 40% market crash, but as empirical evidence of a broken fiat ruler. Positioning your portfolio for mean reversion in a system that lacks the mechanical capacity to mean revert is betting on a world that simply no longer exists.
And, well, synthesizing my perspective, while I completely agree that fiat asymmetry is present and that central banks are managing truly unprecedented debt loads, dismissing mean reversion entirely is a perilous path. The demographic constraints are real, but they are not absolute destiny. AI productivity and technological efficiency gains offer a highly credible mechanical path to outgrow these burdens without hyperinflation.
We'll see.
Interventions like we saw with the yen are stabilization efforts, not the death throes of the fiat system. We must maintain immense respect for market cycles. The tape measure might be stretched, but it hasn't snapped.
Well, I think the one thing we can absolutely agree on is that the unit of measurement itself is under historical, unprecedented stress right now. The old rules of thumb are fraying, and looking at market value through alternative, fixed supply metrics provides vital clarity, even if we disagree on the immediate short-term trajectory of the markets.
Absolutely. We are navigating truly uncharted macroeconomic waters here, and it requires profound intellectual humility from all of us. There is no perfect historical parallel for a 123% debt-to-GDP ratio colliding with the advent of artificial intelligence. I highly encourage everyone listening to dive deeper into the historical data of monetary regimes, study the math for themselves, and form their own conclusions.
Because ultimately, whether you believe the market is teetering on the edge of a historic crash, or you believe the financial tape measure is just stretching beyond recognition, the numbers we are reading are completely unprecedented. And when you are building your financial house, there's nothing more dangerous than trusting an elastic tape measure without realizing the tension it's under.